Hi, Dustin here. I have heard of gossips, hearsays, and online chatters that the U.S. Federal Reserve System, or more commonly called, the U.S. Fed, is being managed by the elite, who comprise the few affluent families who want to cling to power so they can control how the world is being run. Talk about conspiracy theories, you can add that one to the rumor mill. On a serious note, with how difficult times have been in the past year, it is not uncommon for people to wonder, why does the U.S. Fed, being headed by incumbent U.S. Fed Chairman Jerome Powell, continue to hike interest rates? For months now, higher rates have only seemingly made borrowing money more inaccessible, and also, paying off existing debts more expensive, while having little to no effect in tempering rising prices. This is the point of view of many Americans. To be able to understand the relationship between interest rates and inflation, we must first discuss the mandate, or main objective of the world's central banks. If you Google U.S. Fed mandate, the search result will read, "The Federal Reserve System has been given a dual mandate, pursuing the economic goals of maximum employment and price stability." Likewise, Googling the Philippine Central Bank mandate will also produce similar results in principle. The Philippine Central Bank's primary objective is to maintain price stability conducive to a balanced and sustainable growth of the economy and employment. The next logical question is to ask how central banks maintain price stability and employment. Central banks have two kinds of monetary policies in its arsenal to fulfill its purpose for existence. First, central banks can either increase or decrease cash supply in the economy. Though it has become a running joke, the Fed likened to a printing press of US dollars is effectively the US Fed injecting liquidity into the US economy. When was the last time this happened? As discussed in my previous video, stimulus checks were distributed to many Americans so that they will have money in their pocket for daily sustenance, as the pandemic lockdowns resulted to countless business closures and job losses. It was the Fed's way of supporting consumer spending in the U.S. economy, or else public demand would have drastically dropped, causing widespread accelerated deflation, which, according to many economists, is a more difficult problem to tackle than high inflation. Inversely, the U.S. Fed has recently mentioned in one of its press briefings that it is ready to reduce its balance sheet, or in layman's term, reduce cash availability in the U.S. economy. Why? This is an interplay of supply and demand. The main idea is to reduce the supply of US dollars circulating in the US economy. This, in theory, should help reduce consumers' purchasing power, thus lowering demand of goods. The central bank's second weapon is raising or lowering of interest rates. The interest rate quoted by the central bank is the risk-free rate, which serves as the basis for local banks' lending rates. In other words, local banks follow the interest rate movements decided on by the central bank, while adding a spread depending on the level of risk of its borrowers. In essence, interest rates can be seen as a cost of capital. Therefore, if the cost of capital is lower, bank loans and consumer spending tends to increase. The opposite is also true. The higher the cost of capital is, bank loans and consumer spending also tends to decrease. So why is the inflation rate still high even though the US Fed has aggressively increased rates for months now? We must remember that this month's inflation report shows the price movements of previous months. Also, the effect of interest rate hikes is not instantaneous. It will take a while for consumers to digest, react, and change their spending behavior based on the new monetary policy. Other factors that are causing high inflation rates to persist are the increase of global energy and food prices as a result of the Russia-Ukraine war and a strong U.S. labor market, which would signify that many Americans still have disposable income. Then again, the consensus view is that it is better that the U.S. Fed overdo than downplay interest rate hikes, as the problem of high inflation becoming entrenched in society will further worsen the state of the economy in the long run. To date, the U.S. Fed hiking rates has resulted to a reduction in the number and average price of houses sold in the U.S. Clearly, this shows tangible results of lowering inflation in the real estate industry, and hopefully, the other sectors of the economy will follow soon. On a more hawkish note, it is said that in order for the U.S. Fed to effectively combat persistently high inflation, interest rates should be increased to the same level as that of the inflation rate. Will the Fed need to resort to extreme measures to trump over high inflation? It's anyone's guess. Only time will tell. Thank you for listening. If you found value in the information that I have shared with you, would appreciate if you could press the like button and share this video to your friends and family. Also, if you want to listen to similar videos in the future, do subscribe to this channel. Dustin out.